If you've been tracking the strategic moves inside America's biggest banks right now, you know they seem to be walking a political high-wire act.
That's a good way to put it, a real tightrope walk.
Yeah, and today we're trying to cut through some of the noise and figure out what exactly these major players, your JP Morgans, your Goldman Sachs, are doing to prepare for a potential, let's say, shift in power back in Washington.
hmm The stakes are incredibly high, as our sources describe it.
Right. On one side, you have this huge potential reward. The possibility of sweeping deregulation, maybe big tax relief, policies that could be really, really good for their bottom line.
Huge upsides, yeah.
But then the other side is the risk, isn't it? Just sheer unpredictability, that sort of aggressive populist talk, and, well, a history of political volatility sometimes aimed right at the CEOs themselves.
Absolutely. That personal element is key.
So our mission today is to unpack this strategy they seem to be using, this sort of quiet engagement. We want to understand what Wall Street hopes to gain and also what political landmines they're trying desperately to avoid stepping on.
Yeah, and what's really striking is that this looks like a deeply pragmatic strategy.
Hmm.
It's not really about ideology. It seems more about survival, about access, about influence.
Okay.
And it's being executed, you know, by the CEOs, by their lobbyists, who seem to understand they absolutely have to stay below the radar, as you
Yeah.
put it. They're doing this quiet, careful relationship building.
Trying to be seen as helpful partners.
Exactly. Constructive partners, regardless of who actually wins the White House. It's really an explicit attempt to hedge their bets.
But with a big but.
A huge but. The critical thing is they must avoid becoming a public enemy of the former president.
Yep.
That seems paramount.
Because they remember the first term.
Oh, definitely. The corporate memory is very vivid. They got the massive corporate tax cuts, which were obviously welcome. But those gains often felt overshadowed by, well, ending up in the public crosshairs. Like, remember when Jamie Dimon was personally called overrated? That kind of thing sticks.
Yeah, I remember that. So if the goal is to be a partner, but maybe an invisible partner, how are they actually doing that? Who are they talking to? Quietly.
Well, it seems like a multi-front effort. First, there's this active but very quiet engagement with the, let's call it the infrastructure of a potential future administration.
Okay, what does that mean in practice?
Sources talk about meetings with key conservative allies up on Capitol Hill, people like Senators J.D. Vance, Marco Rubio, names that carry weight in economic policy discussions on that side.
Makes sense. Influence the influencers.
Right. But maybe even more critically, they're engaging directly with some influential conservative think tanks. The Heritage Foundation is the big one mentioned.
Heritage, right. And that's where Project 2025 comes in. We hear that term thrown around a lot.
Exactly. Project 2025 is sort of the central point here.
So for anyone listening who isn't, deep in the weeds of political playbooks, what is Project 2025 and why is Wall Street talking to them?
Yeah, that's crucial context. Project 2025 is essentially this massive detailed policy blueprint. It's being put together by these conservative groups, and it lays out exactly how they envision running the government from day one of a new Republican administration.
Yeah.
Staffing, specific rule changes, the works.
Wow. Okay, so it's like the instruction manual.
Pretty much.
Yeah.
And Wall Street isn't waiting around. They're apparently in the room now, trying to provide input, trying to, gently steer the policies being drafted, especially the financial regulations, in a direction they can live with or even benefit from.
Get ahead of it. Shape the rules before they're locked in. That makes perfect sense strategically.
Mm-hmm.
But you mentioned earlier the America First rhetoric. That whole agenda often paints big global banks as part of the quote-unquote elite establishment, right? How does a globalist New York bank square that circle with a populist base?
Well, that tension is the tightrope walk, isn't it? That's the whole challenge. The second part of their strategy is just avoiding political liability.
Staying out of the spotlight.
Completely. Because under that populist America First banner, being a huge international bank, a symbol of the global elite, is just inherently risky. The rhetoric implies, that these institutions failed the average American worker.
So any attention is bad attention.
Pretty much. Their goal seems to be to avoid that public spotlight because it can instantly turn into a presidential tweet storm. Or worse, some kind of regulatory action designed almost to punish them.
Okay, so that's the risk management side. Let's flip to the reward side. If they're spending all this effort staying quiet, what's a specific pot of gold they're hoping justifies all this?
Right. Well, The reward side is potentially huge,
Top of the list seems to be rolling back banking regulations.
especially around capital requirements, right?
Absolutely. You have to start with the Basel III Endgame. That's the really big, contentious regulatory proposal right now. Banks are, let's just say, not happy about it. Briefly, what is it?
It's basically a set of international standards, and the U.S. implementation would force banks to hold significantly more capital, more cash in reserve, as a buffer against unexpected losses.
Okay, technical stuff. But why should someone listening care about capital requirements?
Good question. Because the banks argue, and they argue this very loudly to policymakers, that these rules are just too cautious. Overkill. They say forcing them to hold potentially hundreds of billions more in reserve essentially starves the economy of lending.
Limits their ability to lend to businesses, finance deals?
Exactly. Limits their ability to underwrite deals, finance businesses, basically make money, and they argue fuel economic activity. So the thinking is a Trump administration would likely be much more open to their argument that these rules are just hamstringing the economy unnecessarily.
So getting relief from Basel III offers potentially billions in freed up capital and profit.
Directly translates to the bottom line, yes. Clear, measurable relief.
Okay, so that's number one. Beyond capital rules, there's also this big cultural battle that Wall Street seems keen to step back from, the whole ESG investing thing.
Ah, ESG. Yes, this is a fascinating example of where policy interests align, maybe out of mutual self-interest.
Environmental, social, governance investing.
Right. ESG has been framed by large parts of the conservative movement as woke capitalism. Right. And banks have been really caught in the crossfire here.
How so?
Well, they face pressure from one side investors, sometimes employees, to adopt ESG principles. But then they face fierce political heat, especially from red states and conservative policymakers, telling them to reject it entirely.
So they're stuck in the middle.
Exactly. So aligning with an administration that's actively hostile to ESG gives banks a kind of political cover. It lets them push back against those ESG pressures without facing the same kind of industry-wide backlash they might get if they just did it on their own.
Allows them to focus purely on profit without the social mandate headache?
That seems to be the logic, yes. Prioritize profit over what they might see as potentially costly or distracting social goals.
Okay, deregulation, pushing back on ESG. And then there's the big one, the really core financial piece. Taxes. Specifically, making the Trump tax cuts permanent.
That's got to be the ultimate, probably non-negotiable policy goal for them.
We all remember the 2017 cuts, right? Corporate rates slashed from 35% down to 21%. But a lot of that wasn't permanent.
Correct. Many key provisions are actually set to expire next year in 2025. Making that 21% corporate rate permanent is just critical for their long-term financial planning and stability.
We're talking huge sums of money.
Billions. Annually. Billions in retained profit for these massive companies. The certainty of a low tax rate is just a massive driver for their valuations, their planning, everything.
Okay, so let's recap the potential rewards. Major deregulation, like easing Basel III, getting out from under ESG pressure, and locking in those lower corporate tax rates permanently, that's a pretty big list of potential wins.
It's enormous.
But, and here's where I always pause on this whole calculation seems to depend on predictable policymaking. But the giant elephant in the room, the biggest risk in this whole tightrope act, has to be the unpredictable variable, Donald Trump himself.
Bingo. That's the absolute core of the risk.
I mean, policy agreements hashed out with staff or think tanks are one thing. But how do these banks possibly mitigate the risk of, well, personal loyalty tests or sudden mercurial shifts?
That really is the billion-dollar question, isn't it?
Yeah.
And the honest answer might be, they can't fully mitigate it. They can try to influence Project 2025. They can build relationships, but they simply cannot control the former president's temperament or his well-documented tendency to turn on allies.
Yeah.
The sources we looked at remind us he has a long track record of valuing personal loyalty above almost everything else and attacking people who cross him, even if they've delivered policy wins for him.
We saw that with Gary Cohn, right?
Yeah.
Former Goldman Sachs president, top economic advisor, then out.
A perfect example. Served as a top economic advisor, helped shepherd the tax cuts through, but ultimately resigned after they fell out. And when you're CEO of a major public company, being personally targeted by the president, that's not just a bad news cycle.
It's more than just PR. What's the actual business risk when a bank or its CEO becomes a presidential target?
Oh, it's profound. It's a direct, tangible business risk. It almost certainly means immediate, heightened regulatory scrutiny from basically every agency you deal with. Treasury, SEC, Fed, OCC, you name it.
Right. Suddenly everything gets looked at closer.
Exactly. It invites congressional scrutiny, maybe hearings. It creates PR nightmares that can seriously damage your brand, erode client confidence, spook investors. It just makes the entire operating environment incredibly difficult, uncertain, and expensive.
Which explains the careful dance we're seeing now, like with Jamie Dimon.
Precisely. Diamond is a great case study here. He was openly critical of Trump in the past, quite pointedly sometimes.
Yeah, I remember.
But over the last year or so, you've seen a noticeable shift in his public tone. He's gone from being a critic to, publicly acknowledging that Trump has views that were, quote, correct on certain issues, the economy, maybe some global affairs points.
That doesn't sound like a sudden change of heart.
No, it reads very much like a calculated public, proactive attempt to mend fences,
Yeah.
to avoid becoming a target, to buy some political insurance, essentially, should Trump return to power.
Okay, so it sounds purely transactional. Secure the policy wins, avoid the public humiliation or regulatory pain. But if it's all about those transactional gains, how do they deal with the underlying philosophical tension?
What tension are you thinking of?
Well, these banks are fundamentally global institutions, right? Their business spans the world, yet they seem to be aligning or preparing to align with an America First agenda that often favors tariffs, questions international alliances, things like that. Isn't that a direct conflict for a global bank?
That is the really deep conflict simmering just below the surface. And it's probably why this whole thing feels so precarious, like a tightrope. You're absolutely right.
They want the domestic goodies.
Yes, they desperately want the domestic tax cuts, the domestic deregulation. But their entire business model, especially for the biggest players, relies heavily on global economic stability, on relatively open trade, on predictable international relations.
And the America First agenda sometimes challenges that directly.
Exactly. The isolationist trade ideas, threats of massive tariffs, the questioning of NATO or other longstanding alliances that directly conflicts with the kind of stable, predictable global macroeconomic environment that supports their huge international divisions.
So how do they reconcile that?
It looks like they're essentially making a bet. They're taking the potential for huge, tangible domestic gains, the tax cuts, the deregulation, and hoping those gains are big enough to offset the potential global volatility that might come from populist trade policies or strained alliances.
A calculated risk, then. Prioritizing immediate, measurable domestic benefits over the more abstract, harder to quantify risk of international instability.
That seems to be the working strategy. It's a very tricky calculation, but the focus certainly appears to be on securing those domestic policy wins first and foremost.
Okay, so pulling this all together for you listening, what does it mean? It looks like Wall Street's approach is one of, pragmatic, cautious engagement. They're hedging their bets, playing for access and influence, and it seems purely based on potential policy outcomes, not driven by any deep political ideology.
Yeah, and we can actually see concrete evidence of this preparation. It's not just talk. The banking industry's main trade group, the Bank Policy Institute, BPI, they've actually created a whole new policy area dedicated to election integrity.
Interesting. Why election integrity?
Well, think about the context of 2020. But more than just creating the division, look who they hired to lead it. A former Trump White House official.
Okay, that's a clear signal.
It's a very clear institutional signal. They are actively preparing for all scenarios. They're trying to build credibility on issues that resonate with the Republican base, signaling perhaps that they understand the political language. It shows they feel they simply cannot afford to be caught flat-footed or be on the outside looking in, regardless of the personal or reputational risks involved.
So the final takeaway for you, the listener, seems to be that Wall Street is consciously accepting this very real risk, the risk of unpredictable political dynamics, maybe even public attacks in exchange for the prospect of massive, quantifiable policy victories.
Which really brings us to the critical question, the one that sort of defines this whole dynamic, I think. Given these incredibly high stakes, huge policy gains on one side, versus the risk of unpredictable political warfare on the other, how long can these major financial institutions realistically keep their political stance purely transactional? Meaning, at what point might they face pressure, maybe internal or external, to take more of a principled stand on some of those bigger issues? They seem uneasy about the trade policies or the questioning of international stability that could ultimately hurt their global business. When, or if, does the fundamental need for global stability start to outweigh the immediate desire for domestic tax cuts and deregulation? That feels like the unanswered question hovering over all of this.
That's a fascinating tension to watch, isn't it? Balancing the risk of a presidential tweet against the maybe long-term health of the global economic order they depend on.
Mm-hmm.
Well, thank you for joining us on this deep dive into Wall Street's really complex strategic calculus right now. We've touched on the specific policy goals, the deregulation they're eyeing, and those significant personal and political risks involved in navigating a potential second Trump administration.
It's definitely a space to watch closely.
Absolutely. We encourage you to keep exploring the implications as the political landscape continues to shift.